In a world of financial noise, let's find the signal. Welcome to Smart Money Sense. Have you ever watched an AI demo and thought, that sounds amazing, but show me the money? Well, September 2025 is the show me moment for AI stocks. Today, we're diving deep into why investors are demanding proof of monetization, not just promises of future breakthroughs. By the end of this video, you'll understand which companies can back up their lofty AI claims with real revenue, cash flow, and enterprise traction, and which ones may be all sizzle, no steak. Imagine your portfolio riding a rocket ship, only to discover you forgot the fuel. That's exactly what's happening to AI stocks right now. But don't worry, we've got the fuel gauge and the flight plan. Let's go. The AI hype cycle has been moving at warp speed this year. Everywhere you look, there's another headline. Chatbots writing novels, algorithms predicting your next purchase, and AI tools promising to transform every industry overnight. Investors rushed in, valuations skyrocketed, and optimism was off the charts. But hype alone doesn't pay the bills. Here's how the cycle unfolded. Early 2025. Companies raised billions based on demo reels and visionary roadmaps. Investors poured capital into pure research plays with no clear path to profitability. Mid-2025. Earnings previews began hinting at slower than expected revenue growth in AI product lines. Social media buzz turned into memes demanding companies pay up or prove it. Late summer 2025. Short sellers published reports warning of a bubble reminiscent of the dot-com crash. Traders bet against AI names while retail investors defended their favorite tickers online. Now we arrive at September 2025, the month where quarterly earnings and forward guidance will either validate the hype or fuel a correction. Investors will scrutinize actual monetization metrics, including dollars in the bank, backlog conversions into contract billings, and sustainable free cash flow. This is the show me moment. No one is saying AI isn't transformative. It absolutely is. But investors are rational. They need to see measurable results before writing checks. Here are the 3 core reasons they want proof. Valuation. Justification. Many AI names trade at price-to-earnings multiples far above the market average. To justify those valuations, companies must demonstrate earnings growth that matches or exceeds investor expectations. Cash flow imperative. Research and development in AI is capital-intensive. Without positive free cash flow, companies must raise debt or equity, diluting existing shareholders and adding financial risk. Enterprise adoption. Pilot programs and proofs of concept are exciting, but they don't pay the bills. Only when enterprises sign multi-year contracts and expand usage do investors feel confident about recurring revenues. Case study. Last quarter, a leading AI analytics firm announced a major banking pilot. The stock jumped 30% on the news, until the bank walked away without issuing a purchase order. That single cancellation wiped out $500 million in market cap overnight. Investors learned a hard lesson: pilot success revenue. By demanding tangible results, investors protect portfolios from hype-driven collapses and ensure capital flows to companies with sustainable business models. Let's examine 4 leading AI stocks and the show-me metrics that matter most for each. NVIDIA, NVDA. Business focus, data center GPUs and AI full-stack platforms. Key metrics: data center revenue growth, customer retention rate for AI platforms, uptake of new AI software stack subscriptions. Show me data point. Last quarter, data center revenue grew by 25% year over year, while R&D spend rose by 35%. Investors will ask, is revenue growth enough to offset rising costs? Microsoft MSFT. Business focus, Azure AI services and Copilot productivity tools integrated across Office suites. Key metrics: Copilot seat growth, Azure AI consumption per enterprise account, gross margins on AI services versus legacy cloud offerings. Show me data point. Copilot seats doubled to 25 million active licenses, yet Azure AI revenue only accounted for 5% of total cloud revenue. The question: can AI services scale to become a material growth driver? Palantir, PLTR. Business focus, Enterprise AI analytics for defense, healthcare, and commercial markets. Key metrics. Commercial revenue growth. Number of large deal contract wins over $50 million. Backlog conversion rate, bookings to recognized revenue. Show me data point. Palantir reported a $2 billion backlog, but only 30% converted into revenue last year. Investors want to see that conversion ratio climb significantly this quarter. AMD. Business focus. AI accelerators and high-performance CPUs for data centers. Key metrics. Server GPU design wins with cloud providers. Market share gains in AI accelerator segment. Stability of gross margins amid pricing pressures. Show me data point. Cloud GPU wins rose by 15%, but average selling price fell by 10%. Can AMD maintain pricing power or will margins erode further? Margins in R&D. AI workloads command premium pricing, but relentless R&D lifts operating costs. Companies that will thrive are those where revenue growth outpaces R&D spend growth. Example, if Company A grows AI revenue by 30% but increases R&D by 50%, its margin profile deteriorates. Investors prefer scenarios where R&D increases support revenue growth without eroding profitability. CapEx requirements. Building data centers and manufacturing advanced semiconductors demands billions in capital expenditures. Firms with robust free cash flow can self-fund expansion, while others must issue debt or equity, diluting shareholders and adding leverage risk. Free cash flow, the ultimate proof of profit. Even if GAAP earnings look healthy, negative cash flow signals unsustainable growth. For instance, a leading AI services company reported record revenue but burned $900 million in operating cash flow last quarter. That mismatch is a red flag. Match. Enterprise SaaS versus hardware sales. Recurring subscription revenue offers predictability and high gross margins. Software as a service like Microsoft Copilot often yields margins north of 70%. In contrast, hardware sales such as GPUs carry variable margins depending on component costs and pricing power. Key insight. Investors prize companies with a higher mix of recurring software revenue over one-time hardware transactions. Pilots and proofs of concept are exciting headlines, but enterprise conversions are where the money lies. Here's how leading firms are tackling this hurdle. NVIDIA has built an extensive partner ecosystem, enabling system integrators to offer turnkey AI solutions. This reduces friction and shortens sales cycles, driving more purchase orders. Microsoft bundles Copilot with Microsoft 365 subscriptions, encouraging widespread trial and mass adoption. Once users see value, converting trials to paid seats becomes seamless. Palantir focuses on modular deployments. Customers can start small on one use case and expand to multiple departments. This staged approach improves backlog conversion by demonstrating quick wins. AMD partners with cloud service providers to offer GPU rentals, lowering upfront capital requirements for enterprises. Rental models accelerate adoption and provide AMD with recurring revenue streams. Investors look for publicly disclosed enterprise adoption metrics during earnings calls, such as annual recurring revenue (ARR) growth rates, number of enterprise customers spending above $1 million annually, average deal size expansion year over year. These metrics reveal whether AI solutions are gaining real commercial traction or remaining pilot-only experiments. Key takeaways. Proof of monetization. Growth in AI revenue must outpace R&D spend. Cash flow matters. Positive free cash flow is the ultimate proof of profit. Enterprise traction. Backlog conversions and ARR growth demonstrate real commercial adoption. It all starts with a simple question. This is smart money sense where we find the answers. Looking ahead. As the company earnings reports roll in throughout September 2025, watch closely how executives defend guidance and highlight monetization milestones. The true winners will be those that not only promise the next great AI breakthrough, but can also answer, "Show me the money." You've just gotten one step smarter. To keep building your financial sense, watch this video next, and subscribe so you never miss an insight. This is Smart Money Sense. If you found this deep dive valuable, hit like, subscribe, and ring the notification bell. Drop a comment below. Which AI stock do you think will earn its stripes this earnings season? Share this video with fellow investors hungry for real results, and don't forget to follow us on social for daily insights.